Tuesday morning, you're back with us on Squawk Box. Merlin Rothfeld joins us. He is an instructor at the Online Trading Academy. He joins us from over New York. Merlin, good to see you. I mean, the reason we're talking to you, of course, is to try and get some sort of perspective, a technical perspective. We've been talking about worries about a recession, etc., how the market's been tanking. But, you know, take us back. Let's take a look at the S&P 500, the broadest market gauge over in the U.S. And let's do a 3-year view of that, if we could, and throw that chart up and give viewers a look. And talk us through that. You've got the first level that you're watching is 1174. We can throw that, where are we here? 1174, 1200, so that's round about there or so. What does this level here tell you?
Well, you know, first off, let's start it back. You know, what's interesting about this is normally we would be pulling up a one-day chart, but since this last couple, the last month or so has been such a debacle, we're really looking, have to go back 3 years to find any sort of level of support or, you know, to hold prices up. So last time I was on, we talked about 1,400 being a very crucial level in the S&P. If that's broken, I believe I said we had some tremendous downside movement. So notice we've fallen pretty fast down to levels right around a 20% sell-off. So kind of 20% was a target, which would put us right around 1260 on the S&P. But if you look further down, we do have some support at 1225, which is a simple support level. And then I'd put an ultimate down there at... There we go. We got the remote hand over here for me, Martin.
Yeah, my light pen. I'm having fun doing this. Okay, so there's support.
There you go. Perfect.
Okay, and 20% off its all-time high would put it at what level again?
Well, 20% off the all-time high would put it at 1260, and that's kind of a number that we use for a recessionary. You know, oh, we're in a bear market now. We're 20% down, and
maybe about
just slightly above it. You know, right around 35 points higher than that support level. So I think we're going to head down to that 20% mark, and honestly, I think that you'll see it sell off from there. Unfortunately, I would say that normally, for this week, I would say we would be bouncing, having a little bit of rebound because of the Fed's move last week. But we have a little bit of uncharacteristic announcements coming out this week. So that kind of changes my perspective on it, and I'm looking a little bit more fundamentals right now than I am technical. Definitely after Wednesday, we'll be able to make better decisions.
All right, interesting. You look at both fundamentals and the technicals. Okay, let's zoom in here and take a look at this period. I know you want to talk about this, Merlin. Round about here, I think, which would be about August of '07, up until where we are now, which would be this part here. Okay, I'll tell you what, this is getting a little cluttered, so let's clear that. We're talking about right here to present day, year to date. And let's switch the chart, can we? And zoom in on that period,
sure.
August to now. Change the chart, flip it. Should be coming up momentarily.
Sure. If we look out at this, once we get this zoomed in here, we'll get there eventually, so I'll walk us through as we get there. Our listeners have to imagine that we've zoomed in there. So, you know, once we look into that shorter-term time frame, going back maybe the last 6 or 8 months, what I wanted to zoom in on there was kind of back in mid-August, you had a pattern that for me, as a shorter-term trader, is very crucial. And I call it a hammer pattern. It's a basic candlestick formation. And you had this pattern with high volume on that particular day, and it led to a nice reversal in the market. If you notice what we had back here last Tuesday, is a very similar pattern to what we saw in mid-August of last year. Now that pattern, with the volume associated with it, was leading me to think that we'd have a nice rally going back in here, and I think we'll probably go back up and test that 1,400 mark on the S&Ps. From there, pull out the bulldozers, I think we're going down.
Pull out the bulldozers. Okay, opposite story, of course, for gold, which is shining very nicely at the moment at record highs and closing in on the 1,000 mark. Do the technical charts say that we're going to get there?
Yeah, I think the technical charts say that, but also psychology tells us that, because we have this mindset right now of gold. You know, gold's not going to make it to 800. Oh, gold 800. And all of a sudden it acted like a magnet right to it. And since we've never actually achieved 1,000 on gold, I think you're going to see price kind of gravitate right towards that. Now, if we can, I have a symmetrical pattern that was forming last December when I was speaking with you from Singapore that we didn't get to cover, but back in November and December, you have what's called a symmetrical triangle. And we were basically, while we were teaching class at the Online Trading Academy, we were focusing on that particular pattern as a potential buy point. Now, you notice that once it broke there mid-December, that pattern, we've had a tremendous upside movement. But what I find interesting about this is, just right near the end of the year, you had a little spike in price with high volume, a small retracement, and since then we've started to take off. I would say, you know, this might be an overbought situation, but the volume associated with GLD, the ETF that tracks gold, is actually relatively low. Usually things will turn with very high spikes in volume because there's the emotional factor involved. So until I see gold really have a high spike of volume, I think we're going to keep going up, and we'll probably test 1,000.
All right, interesting stuff, Merlin.